Hey, what's up? Dennis here. I'm a full-time trader, consultant, and coach. And in short, that means that I trade for a living right from my home. I coach other people to trade like me using my system, strategies, and very specific knowledge, which I then work with people to turn it into know-how. And finally, I train companies in the financial markets by providing them education, very specific education. Anyway, in this video, we're going to be going over my risk management technique, which I believe is probably the best Forex risk management technique out there. If you want to learn more from me, you can go to pipsmatter.com. If you're watching this from pipsmatter.com, explore the website and make sure you reach out to me. I can really help you with your trading, but this video is not about that. Let's move right into it. So this is my risk management technique. Like everyone else in trading, one of my main weakest points was managing my risk. I tried reading books and everything else that I found online, but nothing really actually worked for me. So I went into self-developing something that's tangible and applies to me as a trader, and pretty much the rest is history. Before I move into the actual technique, I want to explain to you why I created this and how it was created. So, I'm good at trading. I'm really good at spotting specific patterns, and I'm one of those active traders that likes to make a lot of money because I think that money is important, actually vital to any kind of civilization that depends on money. So money is everything from good clothes or just clothes to a warm home or just a home, to schooling for your child or medicine or whatever else you need money. Money is the headphones or PC or laptop you're listening this on, or phone. It's also the electricity and the internet you use, and absolutely every single piece of clothing you're wearing on you, unless you took it from the floor somewhere. But anyway, so money is important. I like to make money, and I was a bit more of an aggressive trader, so I'd really look for big spikes in my equity curve. And that didn't really work out well for me until I created something like this. So now I can make 50, 60, 70% in a week without really going overboard on my risk. But I also realized that, yeah, I am good at trading and the system I created is pretty accurate. The only problem is it's, of course, not 100% win. And I remember this one time I was shorting the Euro GBP. I was up a crazy amount of percentage, like something like 500% for the year. That was last year, 2019. And I messed it all up by going short Euro GBP and not really applying the specific nations of this risk management technique. Anyway, that loss turned into a really important lesson because I went on a self-discovery, self-developing journey, and I created this baby, and ever since then, my life has been great and my trading has been absolutely extraordinary. So, my risk management technique is broken down into two parts. The first one is using structured position sizing at all times. I'll come and explain both points. I'll dissect them and explain them. The second thing was having a definite and very unique exit tactic for every single setup. That's how it was done. Now, when I combined these two, I got exactly what I was looking for, and it was concrete and not that generic bullshit that we see online or in books. Never risk more than 2% of your account. That got me nowhere, and it's getting you nowhere too. Because 2% is what? When a hedge fund manager is telling you don't risk more than 1%, hell yeah, when you got 100,000, 200,000, a million, 10 million, maybe even a few billion. Of course, you're not going to risk more than 1% because 1% is 100 grand, 10 million, 100 million. But me, you, ordinary traders, we're trading with hundreds and thousands. And I say hundreds, $100, $200, $300, $500, or 1,000, 10,000, 20,000. No doubt we can't do that because it's going to take years for us to be able to turn our trading into a real cash flow. So I created structured position sizing based on my balance. I'm going to explain this pretty soon. Now, what I'm going to do is I'm going to dissect these two and explain them in detail with everything I got. The only thing I need from you is your complete attention for just a couple of minutes. Now, I'm sure that you can do that for me. If you're really serious about being a trader, you are going to do that right now. By the way, This stuff can really change your trading forever to the good side. So make sure you're applied. And if you don't understand it, reach out to me and I'll tell you. Now, structured position sizing. What is structured position sizing? Very soon I'm going to show you our little Excel tool which guides us step by step to either increase or decrease our position sizing, depending if we're losing or winning, of course. So if we're winning, at the end of the week, what we're going to do is increase our position size. And I'm going to explain that pretty soon when we come to the Excel. But let me answer one very important question first. Structured position sizing is simply you not opening a bigger position than X amount of lots based on your starting balance of the current week and not increasing your lot size until the week is over. Your balance is your guide to what position size you take. So for example, if you have 10,000 balance, your position size cannot exceed 0.9 lots per asset. Now let's go into the actual Excel and I'll explain that in just a second. Right on. So this is the weekly compounding formula. Now let me explain it to you. You have your initial starting balance and you have your weekly growth target. For me, it's 6.5% based on the starting balance of 10,000. That means in the first week of trading, I'm targeting to win $650. You understand that I slowly and gradually grow, but because 6.5% on 10,000 and on 19,000 is very different, my balance is increasing, so is my position size, and my target for the week is increasing, but because I'm slowly increasing my position sizes, check this out. So when I go from 10,000, let me just copy this. So at 10,000, as you can see, my lot sizes are 0.9 to 1. 1 for extremely sure assets, setups, and 0.9 for general stuff. But this is my maximal exposure. That doesn't mean I should be opening that on every lot. So this is what I earned this week, 57%. Now I'm doubling up. But I do not increase my position size until the week is over. So I only update this on Friday, Saturday, or Sunday. Friday if my trades are closed and I'm done. I update this and then I mentally prepare for Monday and I'm ready to start trading with 1.8 lots per position. Excuse me. Now if I lose this week and I go down to 12,000, as you see, my now lot size next week is dropping. But then if I go up, I'm increasing the following week. But gradually, I'm not doing this crazy stuff. So this is called structured position sizing. It's correlated to the balance and the actual growth of the account as the account grows week on week. So if I start 15.7K and I on Monday go to 30,000, that doesn't mean I'm going to be increasing my lot size to this. I'm not going to be increasing my lot size whatsoever. I'm going to wait for Monday because so much can happen in a week and we want consistency and we do not want craziness. But hey, on the bright side, if I focus on my 6.5%, which is very doable as you see here, at the end of the year, I'm looking to earn 248 grand, or that's going to be my net balance. So about 36,216 and 13 cents in profit. Another video, another time. Let's go back to the PowerPoint. So I showed you the actual structured position sizing sheet. I hope you understand what I'm talking about, and I'm going to give you the two main benefits for this. The first one is you have controlled exposure. You can't get very hurt. If you have 10,000, 0.9 lots, you're not going to get very hurt unless you have a 100 pip stop loss. And based on the way I trade, which is day and swing trading, well, I'm not going too crazy with my exposure. My stop losses are pretty normal. They're not above 50 pips. And soon you're going to understand when I come to the actual tactic of the trade that I don't have set stop losses and I do not risk set amount of percentage. I based it on a risk-reward ratio of what's happening. What am I targeting? If my risk-reward ratio is 2 to 1, then I'm fine to open 0.9 lots. And if the trade, the specific trade, the market team, and everything is with me, the setup, then it's fine. But if I'm trading against the market team, for example, coronavirus, WTI is going down. If I'm going to start buying WTI, I'm going to decrease my position size by 50%. But all of this will be taught to you if you actually contact me and go with my private coaching, which will explain to you absolutely everything. The second main benefit is you're gradually growing your position sizes week on week, or decreasing them if you're losing. If you get a losing period on your trade, trading, or if you have a negative edge of your trading system. But you're gradually growing your position sizes, which means you're basically controlling. You're the guy in control, or the girl. You have control over your trading, and I gotta tell you that it's really important, because once you stick to this, you have structure. And when you have structure, guys, you're essentially controlling your mind. You're not gonna get very excited and stuff, because now you're trading as a professional. So I explained to you structure position sizing. It's extremely important, and this thing correlates to my risk management. Now the second point here, just give me a sec. The second point is a definite exit tactic. Every trade that I take has a different tactic. Imagine this: you're a football manager, soccer manager, basketball manager, hockey manager, whatever the hell you are. Every team you play, you're pretty much going to have a different tactic, because sometimes a player might be injured, you might be playing a stronger team than you, a weaker team than you. Same thing with trading. No trade is ever going to be the same. Now, when it comes to success in trading, there are two factors we need to take into account. I'm not counting the third one, which is probably the most vital one, which is mindset. I'm not here to speak about that right now, but you need these three. I'm going to focus on just the process and the trading process only. The first is your trading system. Number one is trading system. It has to be complete and govern every part of your trading. What are you trading? When do you enter, and so forth? Blah, blah, blah. Okay, that's your trading system. What patterns you trade, how long you trade, blah, blah, blah. The second thing is your trading tactic. Every trade is unique, so you need to prepare each setup differently. Now, when you're creating a tactic to buy Euro USD, for example, the first thing we need to locate is, of course, our entry. When are we getting in? But while we're doing that, we need to also get our exit ready. In fact, we do not enter a trade until the exit is not predefined, set, and established. When we have the exit, we know how much our structure position size will be. We know that the maximum on 10,000 will be 0.9 lots, maybe one lot, which is the maximum actually, 10%. Bada bing, bada boom. So when we find that, and if we see that the stop loss should be 50 pips, well, then we don't want to go with one lot, because that's 5% risk. So we can lower it to 0.9, 0.8, 0.7, 0.6, 0.5. Now, the lower we lower it, the more threshold we have to enter later on and build our position, or compound it. Let's say we find Euro USD buy and we enter 0.6. What we're left with is 0.4 of lots to enter on this trade. Meaning, when price action breaks out of a specific reversal contraction, double top, double bottom, blah, 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 and we are clearly, if you don't know about me, we are proactive traders. We are reactive to the chart. As the chart moves, we move with it, but we're proactive to the information it gives us, so we can actually find further entries, get out of the trade early, and so forth. And if we find a reason to continue, a continuation pattern within this pattern, we can add on the rest 0.4, 0.3, 0.2, 0.1, and build our position up, and therefore increase our profit potential. Get it? So, the main benefit of having a definite exit tactic is you're professional and your trading is organized. You really are professional. It helps with your mindset. The second thing is you have limited losses. You control your loss by knowing where you're going to get out, because essentially your trades should be ending in one of four ways: big win, small win, break even, small loss, right? So, having a tactic for exit on every single trade will help with that. And finally, you have the ability to have margin to enter other trades. So if you're buying Euro USD and you see that gold has a massive potential to go up, you still have margin to fight and grab that elephant trade. Your bullets are there, and you can just shoot that elephant right in the head. Sorry, I don't mean to actually shoot the elephant. But you know what they say, if you don't have bullets in your trading account, when that elephant trade comes and you're like, damn, I'm missing this massive trade because I'm stuck in this one, you won't be stuck in this one, because your loss is going to be okay to even cut it, and you're going to have margin to fight on another trade. So essentially, this is my risk management tactic. We're done. We're done, we're done, we're done. Summary, trading is very hard and the risk of loss is absolutely always there because in order for us to profit, we must first risk. Love risk. I'm gonna make a t-shirt for Pips Manor. I love risk. I'm a trader. And until you do not close a trade in profit, there's no profit. So you need to play great defense in trading. It's not just about converting charts into profit, but more importantly, retaining that profit. This video explained my little tactic for risk management. And if you really apply this, it's going to change your trading forever to the positive side, as it has mine. Guys, girls, convert and retain. That's the motto of this video. Convert and retain. Retain is protect. I'm giving you guys a really nice bonus here. Join my coaching program right now and get free access to my new Udemy course, Making and Compounding Profits in Forex Trading. The course explains the keyword profits and goes into how I make profits, how I keep profits, and how I multiply/compound profits. So, how I make profits, keep profits, and compound profits. If you want to join my community from tomorrow, which is Monday, 3rd of February, the pricing is increasing by 30% to 72 for the monthly, 195 for the quarterly, 650 for the yearly. Right now, it's as follows: 56 for the monthly, 150 for the quarterly, and 500 for the yearly. You want to get coached by me? This is how you do it. If you were watching this on Sunday, 2nd of February, you can still jump in on the cheaper prices. So send me an email on dennis@pipsmatter.com and I'll get you in there. Thank you and have a beautiful day and happy February.